Hello guys, this is Xolile Khatebe and welcome to yet another video of accounting, and today we are going to be focusing on the financial statements. So before we start, I would like to really remind you of the conceptual framework, and more specifically the objective of financial reporting. So remember, on the conceptual framework, we said that the objective of financial reporting is to do what? The objective of financial reporting is to provide useful information. This is what we said when we spoke about the conceptual framework. If you want to remind yourself about this, please go back to our previous videos. You'll see what I'm talking about. So on the conceptual framework, we said that the objective of financial reporting is to provide useful information. So this useful information, who is the target market for this useful information? So this useful information is reported to the people who have provided funding to the business. So those are the existing and potential investors. So it's investors, which I said represents equity, creditors, and other lenders. And this represents liabilities. So we said that the objective of financial reporting is to provide useful financial information to existing and potential investors, creditors, and other lenders. So those are the parties that have provided the business with funds so that it could buy assets and start operating. Since these parties provide the business with funds, we have to report back to them, and we do that by presenting financial statements to them. So in accounting, we say that there are 5 financial statements that the business has to prepare. So the financial statements that the business has to prepare, it includes the statement of profit or loss. So the statement of profit or loss, it tells the people who are interested in the business about the performance. So when we speak of the performance of the business, we are trying to answer the question as to whether or not did the business make a profit or not, or a loss. So I want to know if the business made a profit or a loss for that particular 12-month period that we are trying to measure, which is the reporting period. And then the second one, it's called let's use a different color. It's called the statement of financial position. So with this read, you are trying to understand how much assets does the business own, and how were those assets bought. So that's why we speak of now the financial position. That's why we say it's the financial position of the business. So the statement of financial position is divided into assets, equity, and liabilities. So you would want to know as an investor if the business is funded through equity or liabilities. Because if the business is funded through liabilities, for an example, it means that it's going to owe a lot of money to other parties, and that means that the interest that the business is going to pay is going to be high, for an example. So that's your statement of financial position. Then when it comes to the statement, the next one, which is the statement of changes in equity. So what are we trying to do here? With the statement of changes in equity, the question that you are trying to answer, you want to know really how much has the capital structure of the business changed during the year. So you want to know, okay, how much capital did the business start with at the beginning of the year, and how much capital does the business have at the end of the year. So you want to understand the movements in capital during the year. And then the next one, it's called it's the statement of cash flows. So with the statement of cash flows, you really want to understand the movement in cash. Most people, they always ask what's the difference then between the statement of profit or loss and the statement of cash flows. The statement of cash flows only involves the movement in cash. So you want to know like how much cash has moved and where did majority of the cash go to during the year. Whilst with the statement of profit or loss, it also includes non-cash transactions. So that's why it's not a true reflection of the movements of cash. So that's why then we have to prepare the statement of cash flows so to understand the movements of cash, the movements of cash in the business. So these are the four statements that you have, and then these statements now are accompanied by what is called notes. It's called notes to financial statements. And the only note that you'll be required to prepare is this one, which is note number, it's called note number 3. It's for fixed or tangible assets for this particular course, of course. So the ones that you are going to be asked to prepare, or the ones that you are required to know how to prepare for this year, it's the statement of profit or loss, which measures profitability. And then it's the statement of financial position, which is just a snapshot of the business at a particular point in time. And then number 3, it's the statement of changes in equity, which is the movements in capital, And then the fourth one, this one you are not supposed to know it for this year, for this first semester or first year course. But you are not supposed to know it for this year. It's called the statement of cash flows. I think you'll do it as you go further with your accounting. And then you also need to know how to prepare notes to financial statements. So notes to financial statements is just the accounting notes that actually explain some of the line items or some of the amounts that appear either on this statement, or this statement. So they explain some of the amounts that you see here. So we do that by preparing notes to financial statements. And the note that you'll be required to know for this course is note number 3, which focuses on fixed or tangible assets. You are still going to do that. So this is what you have now in as far as the financial statements are prepared. But before we go deep in terms of explaining to you how to prepare these statements, there's certain principles that you need to be aware of, because we apply them a lot when we are doing our financial statements. So firstly, I would like to then explain the difference between a transaction, versus an adjustment. So what is a transaction? A transaction happens between, so it happens between the business and an outside party. And for an example, when the business buys trading stock from a supplier, so that's between the business and the supplier. When the business is charged by the bank for bank charges, that's between the business and the bank. When the owner invests capital into the business, that's between the owner and the business. So it's always between the business and an outside party. And then an adjustment is an internal procedure. So it happens within the business adjustment. It's within the business itself. Why do we adjust? We adjust transactions, or we adjust financial information so that it meets one of the primary characteristics of financial statements, which is faithful representation. So remember, we said that when information is faithfully represented, it means that it must be free from errors and omissions. So when you're adjusting, or when you create these adjustments, you are trying to fix these errors and omissions. Whilst the transaction is a business agreement that happens between the business and an outside party. So another difference is that transactions happen daily, and then this one is adjustments are prepared at the end of the period. So that's what you have. So that's the differences. So you have been working with transactions for the past few weeks. Up until now, you have been working with transactions, and then from now on going forward, you will be exposed to adjustments, especially in this topic, financial statements. You are going to be exposed to adjustments. Then the next one, I need to explain as well the reporting period. So the reporting period is just any 12-month period. 12-month period, and that we are going to focus on as we are preparing our financial statements. And remember, we need to prepare our financial statements which are relevant. And so when they are relevant, it means that you need to have these financial statements that have the information that you really need for a particular point in time, for an example. And for you to be able to make a decision as an investor, you would want to have the most recent piece of information as possible about the company, so that you can take a decision now. So it's a 12-month period that we are going to focus on. That's the reporting period. And for most businesses, it's from March to February. And that's for most businesses, but it can be from June for some businesses to let's say May the following year. And the business is the one that has the option, really, or the choice of choosing which financial year or which reporting period they want to focus on as they prepare my financial statements. But it needs to be fixed. So what I mean by that, it needs to be the same period each and every year. So you can't choose, for an example, March to February, and then the next day you choose June to May. It doesn't make sense. So if the business uses March to February, it needs to use March to February each and every year. So that's the reporting period, and that's the 12-month period that we are going to focus on as we are preparing our financial statements. So you as a student, when you get a question, this is the first thing that you need to identify, or this is the first thing that you need to highlight as you are reading your question. And then another principle that I'm going to speak about once again is the going concern. Is the going concern principle. This is one of the most important accounting principles, because it's the assumption that your financial statements, it's that the financial statements should be prepared based on financial statements should be prepared based on the assumption that the business will continue to operate in the foreseeable future. So what does this really mean? It means that now the balances that the business has for a particular 12-month period, let's say the balance for inventory for the year is 12,000 for an example. So because we assume that now the business is going to continue to operate in the foreseeable future, this closing balance, it means that it needs to be an opening balance on the following year. So we need to create these balances because we assume that the business will continue to operate in the foreseeable future, which is the next year. If, for an example, for whatever reason, the accountants decide that the business is not going to continue to operate in the foreseeable future, we need to prepare our financial statements based on different principles, not the ones that you are going to be taught for this course. So this is one of the most important accounting principles that you need to understand. It's just the assumption that we use when we prepare our financial statements, and we say that we prepare them based on the assumption that the business will continue to operate in the foreseeable future. And then the next principle now that you are going to use, which is important for this topic, is what is called the accrual basis of accounting. It's very important. So with the accrual basis of your accounting, it speaks to the income and expenses that the business generates. So according to the accrual basis of accounting, we say that the income and expenses incurred should be recorded during the period in which they occurred. Not necessarily when cash is received, or you can say that even if payment or their consideration is received in a different period. So the accrual basis of accounting states that income and expenses incurred by the business, they should be recorded during the period in which they happened, not necessarily when the consideration is paid or received. So what that basically means is that if now you have someone who pays for something this year which was supposed to be paid for next year. Let's say you are running a gym, and remember, a gym works with contracts, and so you'd find that maybe for this 12-month period, you find that there's a customer who wants to pay for this year, for 2023 plus 2024, and so the money for 2023 belongs to 2023. That's fine, but the money for 2024 was received in 2023, but it belongs to 2024. So the accrual basis of accounting says that this money, and because it belongs to 2024, it needs to match the period that it belongs to. This money belongs to 2024, so it needs to be recorded, or we need to account for this income not in 2023 but in 2024. And so you will find that with most of the incomes and expenses, you'd find that the period does not match the payment. So sometimes money is received in advance, or money is paid in advance, or sometimes not enough money is paid for a particular expense, or not enough income is received for a particular expense, which is the 12-month period. So for us to be able to match income and expenses with the period, and for us to be able to match the income and expenses with the period, what we do, we have to create these 4 adjusting accounts at the end of the year. To match income and expenses, which is what the accrual basis of accounting forces us to do, to say we should match our income and expenses and with the period in which they were incurred, or with the period in which they happened. So we have to match them. For us to be able to match them, we have to create adjusting accounts at the end of the year. So we need to adjust now these particular transactions, or these incomes and expenses at the end of the year, so that they match the period. So there are 4 adjusting accounts that you need to be aware of which you are going to use a lot from now on going forward. So you would have to prepare these adjusting accounts at the end of the year. These adjusting accounts, these are accounts that are just created to adjust your transactions, or to adjust your information, so that we are able to account for only transactions that belong to a particular financial period. So let's do this. So these adjusting accounts, we have 4 of these adjusting accounts. We have 4. And then the first one is the accrued income. So with the accrued income, it's income that you are still expecting to receive. So you'd find that in a 12-month period, they might say to you rent was only received for 10 months, for an example. So the rent that's reflected on the trial balance is for 10 months. And then you find that there's these 2 months which is still accrued. So it still needs to be received. And so this is going to be your accrued income. And so it's income that you are still expecting to receive. Because you are measuring 12 months, the income should match the period. So the income that we need to receive for rent, it needs to be 12 months as well, for 12 months as well. But if they tell you that we only received rent for 10 months, it means that the 2 months is accrued income. So it's income that we still need to receive. Accrued income is the same concept as receivables. Receivables is income that you still need to receive as well. So that's why receivables are an asset. So that means that accrued income as well is an asset. So you treat accrued income as an asset. So for this particular example that I made, if rent was received for 12 months, for 10 months, so you would have your a rent income, which is an expense, and then you would have your accrued income, which is your asset. So you'd say that I still need to receive rent for 2 months. Sorry, I still need to receive rent for 2 months, and this is accrued income. And then under accrued income, because this is an asset, and then you'd say that you have a rent income that you are still expecting to receive, and rent income that you are still expecting to receive on the debit side. So this is how you record this. And then the second one is an accrued expense. Number 2, it's accrued expense. So accrued expense is the opposite of accrued income. So it's an expense that you are still expecting to pay, or it's an expense that still needs to be paid. And so you'd find that same thing, the financial year is 12 months, but they will tell you that insurance was paid for only 8 months, for an example. So the rest of the 4 months is an expense that you still need to pay, so it's like a liability. So this accrued expense, we treat it as a liability. And so it means that you are going to debit, you are going to do this when you record insurance and then accrued expense. So this is a liability, this is an expense. And so what you are going to do here is that you are going to say, I'm still expecting, or I still need to pay insurance for 4 months, which is this, and this is going to be your accrued expense. Then this is your liability, accrued expense, so you are going to credit it on the, you are going to credit the accrued expense account with insurance, for an example, as you record this. And then the other one, you have number 3, you have your prepaid expense. So this is an expense that is paid this year, but it belongs to next year. So we have paid this expense in advance. So how would you visualize this? We find that this is the 12-month period, which is the reporting period. But Rona, for an example, we have decided to pay for, let's say, 14 months. And so these 2 months that we have paid in advance, it's your prepaid expense, for an example. So the expense is paid prematurely by 2 months. So a prepaid expense, we treat that because it's money that we are expecting to reverse for the particular financial year, is treated as an asset. And it's a prepaid expense, so it's treated as an asset, so it needs to be debited. So you'd find that they will tell you that we paid example of a prepaid expense. Yeah, you'd find maybe, for an example, that we paid for insurance again for 14 months, or the rent expense was paid for 14 months. So you'd have your rent expense, and which is an expense, and then you'd have your prepaid expense, which is an asset. So you would now, because it's paid in advance, this and is paid in advance, your rent expense needs to be reduced now. So what are you going to do? You are going to debit the asset prepaid expense, and then you are going to reduce the rent expense. Remember, rent expense is an expense, which means that it increases on the debit side to reduce equity on the debit side, or is always debited. So to reduce that expense, you are going to reduce it on the credit side. So that's why you record here. So you are reducing the rent expense because you are saying that the rent value was paid in advance. So I need to reduce it. So yeah, so prepaid expense is an asset. And the last one is the income. Number 4, it's income received in advance. So with income received in advance is the opposite of this one. So now it's when we are receiving income in advance. So you might find that they tell you that interest income, for an example, was received for 13 months. So if you find yourself in a situation like this is the financial year, which is 12 months, and you receive interest for 13 months. So this 1 month is the one that is paid in advance, or is received in advance. So this is going to be a liability. Income received in advance is a liability. So when you record this, you would have your interest income, which is an equity account, and or let's say which is income account, and income increase on the credit side, and then you would have your income received in advance here. Income received in advance is a liability, remember. So this is a liability. So you'd credit the liability, income received in advance, and then reduce because the income is received in advance. So you'd find that here maybe it was 1,000, and the rent, let's say, is 1,300 for an example, and the rent maybe is 100 rand per month. So it's supposed to be 1,200. So you'd have to reduce this by 100 rand. So you have to reduce it on the debit side. You are reducing the income, and income you reduce it on the debit side to remove the 100 rand that was paid in advance. So these are the 4 accounts that you'd have to prepare, or that you'd have to do at the end of the year to adjust your financial information. So this is done at the end of the year. This is done at the end of the year, and then at the beginning of the new year. So at the beginning of the new year, because now we are done adjusting, and it's a new year, we have another 12-month period to measure these adjusting accounts. So the balances that you have from rent, from accrued income, accrued expense, income received in advance, and prepaid expense, they have to be reversed at the beginning of the new year. So how are you going to reverse this? So what you are essentially going to do is that you will have your accrued income balance, which is this one, and then it comes from here, which is last year. And so because accrued income, accrued expense, prepaid income, income received in advance are adjusting accounts, at the beginning of the new year they need to be reversed, because they were only prepared, or they were only created just last year so that we could adjust the financial information for that particular financial accounting period. So on the new year we need to reverse them. So let's say you have this balance of 200 from last year, accrued income. So on the new year you are going to reverse this now. So you would have to reverse it. So when I say reverse, you just make this account to be 0. So you'd say 200 is from rent income, and then you'd come here as well, and then on the rent income account you are going to have a accrued income of 200. So how will this come now in a test or an assessment? So they will tell you that at the beginning of 2022, for an example, let's say the financial day is 20.222, so it's March 20.22 to Feb 20.23. So you'll be told that there is an accrued expense of 200, for an example, for rent. So that means that on your rent income account, you are going to start with a negative of 200. I hope this is making sense. And then let's do another one so that you can understand. Let's do accrued expense. And here we have, say you have accrued expense of 100 rand. Let's say this amount was 100 rand here for insurance. So you had insurance that you still need to pay last year for 100 rand. I get it. So what you are going to do on the new year, avoid the beginning of the new year, you'd have to reverse this, because this was only created last year so that we could match the expense, which is insurance, with the period in which it happened, which is 2022. So now it's a new year, they will tell you that there's an accrued expense of 100 rand for insurance. So the first thing that you'd have to do, you'd have to reverse this balance. So you have to do this accrued expense and then insurance. So remember, the balance here on accrued expense was credited, so we had a credit balance. So you'd have to remove this or reverse it. So that means that you would debit accrued expense so that you reverse this account, and then the contra account is with insurance. And then this now will come here under insurance. Then the 100 rand here, you can say balance brought down, or you can say it's from accrued expense. So that means that you have a negative opening balance under insurance on the new financial period, because we had to reverse first the accrued expense from the previous year. So I just hope this makes sense. So yeah, this is how now you are going to be tested based on these things. This is how you are going to be tested based on these things. And then this video was just for me to give you guys a background or a breakdown of the principles that you are going to be expected to apply when you are going to be doing our financial statements. The video that is going to follow this one is going to be based on an example. We'll do a live example together so that you are able to understand now how to apply all these principles so that you can prepare more financial statements.